In lesson 5 of this course, when we were discussing the preparatory essentials of investing, do you remember the step where we discussed setting up an emergency fund before you started investing, especially ahead of a recession? Well, this lesson is going to be in alignment with that and is going to get a bit more informative about emergency funds. So, as we've already discussed through several lessons, you now know that recessions are challenging times for the economy and hence also for the people living in that economy, because recessions bring in the threats or risk of pay cuts, then unemployment, sudden unaffordable bills, and so on and so forth. That's why for anyone planning to invest, well, frankly, even if you don't have plans to invest, having an emergency fund set up ahead or at the present of a recession is very, very important. Now, the question that most ponder upon is where exactly to keep the emergency funds. Some others wonder why the investments they make, say like stocks or bonds, can't function as an emergency fund. Because after all, the funds can be pulled out at times of emergency, and that should serve as an emergency, correct? But here's the thing, I've mentioned this in lesson 5 as well, but tying up an emergency reserve in an investment like stocks or bonds or precious metals or forex is very, very risky during a recession. I mean, we did see how the markets reacted to recessions, right? They fluctuate like crazy during recessions and before they even stabilize. So if that's the case, you pulling out your investments when the markets are at an absolute low, let alone a normal low, you'd be taking massive losses. Finally, all the effort you would have put into investing and all the time you would have held those investments would be for literally naught. That's why it's important for emergency funds to be kept as something that's very, very liquid, like cash. I don't know if you have heard this phrase. It's popular among investors and it goes, cash is king. During economic downturns especially. If you think about it, that's actually almost accurate. Now, we know that emergency funds should be kept as cash or a very, very highly liquid form of investment. Apart from that, you also need to keep an emergency fund where your money is safe and is accessible and does not lose as much of its purchasing power due to inflation, which, let's be honest, will likely happen during a recession. So simply put, you need an investment option where your emergency fund will grow and is still accessible if you need it in a pinch. This is where you can make use of high yield savings accounts. So to give you some background, when the banking space was starting to be taken over by the internet, two important disruptions happened, of which one was traditional banks started serving customers from all around the country and even the world via online banking facilities. And two is that there are now new types of banks called internet-only banks that were introduced. So with all these happening, the competition in the banking and the finance industry kept on increasing, with each bank competing on the savings account interest rates. Eventually, this led to a new category of savings accounts called high yield savings accounts that were introduced. Now, there's nothing complicated about high yield savings accounts. They are like normal accounts, or rather normal savings accounts. They are both structured very similarly, they're regulated the same way, and more often than not, they're both insured. The only difference between these types of savings accounts is their interest rates. A high yield savings account tends to have an interest rate that is about 17 to 25 times more than a national average standard savings account. So right now, for example, in the US, while the average savings rate of a normal savings account is about 0.21%, the rate of a high yield savings account is about 3.6%. That's about give or take 17 times more than the national average. Now, I don't know the difference or if this difference in percentage seems too little to you, but look at it this way. Let's say you have an emergency fund of $10,000, right? And you kept it in a high yield savings account that pays a daily compound interest of 3%. And now you keep this fund for 5 years, you will be earning a return of $1,618 just in interest alone. Leave it for 10 years and your 10,000 becomes 13,498. Now if you have kept the same $10,000 in a normal savings account which pays an interest of only 0.5%, then you would have earned only $50.82 in over 10 years. If you take all this information and analyze it, you will be able to see that given high yield savings accounts are as liquid as traditional savings accounts, offer protection on your principal investment, they offer a safety of federal insurance that's the same as a traditional bank accounts, and on top of all that, they offer very, very high interest rates compared to normal savings accounts. So high yield savings accounts are a great place to keep your emergency funds. Although you need to bear in mind now, we are recommending this as an investment option only to keep your emergency funds. However, the high yield rate is, it won't be as high as other investments like stocks, for example, and therefore it's not suitable as an investment for your investment goals like buying a house or a car or setting up a retirement fund.